Guys, this video is a high-level guide on some of the most powerful ICT concepts that we've found extremely effective for consistent trading success. Today we'll break down the meaning, core principles, and proper chart application of each concept to guide you in spotting high-quality trade setups. If that sounds like your thing, don't forget to hit the like button to support us and subscribe to our channel if you're new. Catch you after the intro and disclaimer. Let's begin with the first concept: imbalance, inefficiency, also known as fair value gaps. The SMC trading strategy relies entirely on price action and monitoring institutional behavior, commonly referred to as smart money, directly on the chart. Smart money represents massive order flows executed in the market by banks, hedge funds, brokers, and other large-scale financial institutions with significant capital. How can we recognize smart money activity directly on the price chart? Money by detecting imbalances. Since imbalance, inefficiency, and fair value gaps are closely related concepts. When smart money flows into the market, it disrupts the balance between buyers and sellers, triggering strong price moves marked by large candles and visible gaps between the wicks. In such instances, the price action is labeled sell-side inefficient, and fair value gaps form between the wicks. A fair value gap appears as a three-candlestick formation where the wicks fail to overlap. Here you can see examples of efficient and inefficient prices. In the first example, we have a clear bullish fair value gap between the shadows indicating sell-side inefficiency. On the contrary, if you look at the second one, you'll notice the wicks meet in the middle, therefore we do not have value gaps and the price is efficient. Now, how can we use this to our advantage? When the price moves significantly and leaves fair value gaps behind, it usually returns to these areas to fill the gap and restore balance. These areas become extremely important supply and demand zones, offering potential trading opportunities. In this example, the price is moving in an uptrend. In this area, the price has created fair value gaps indicating buy-side imbalance and sell-side inefficiency. Below the imbalance, we can find the demand zone, as this demand zone has contributed to the imbalance. Let's imagine the price creates another pullback and we have another demand zone. The key difference is that the second demand zone has no imbalance, therefore there is a greater chance for the price to make a deep retracement to the demand zone that created the initial imbalance. This is because the inefficiency will act as a magnet for the price to come and fill this gap. So witnessing this scenario on the chart, we will aim for the demand or supply zone that created the imbalance. This zone has a greater chance to reverse the price compared to zones associated with efficient movements. With all being said, the imbalance is a strong SMC signal and one of the first things we spot on the chart. However, just like similar concepts, it needs to be used in combination with other factors to make a well-informed trading decision. The next concept we'll cover is liquidity. Liquidity is fundamentally influenced by the locations of stop-loss placements. Wherever stop losses are placed, liquidity tends to accumulate. Smart money depends on activating stop losses to tactically enter the market, enabling them to secure their positions efficiently. Every swing high and swing low contains liquidity. We know that if the price pulls back to this area, many price action traders will go long and put their stop losses below this level to benefit from the bull market. As price nears the swing high, traders often secure profits or initiate short positions around the resistance level. Thus, we have liquidity below the swing lows and above the swing highs. In an ideal uptrend, the correction will happen inside this range and the price will continue pushing upwards once it has gathered enough bullish momentum and liquidity. Many price action traders are observing the chart and looking for a signal to go long. This is why a bullish engulfing candlestick often marks a significant liquidity zone. Many traders interpret it as a bullish signal and enter long trades, placing their stop losses just beneath the engulfing candle. However, as smart money traders, we aim to enter after those stop losses have been triggered. So, if a demand zone exists beneath this candlestick, we wait for price to reach our zone before initiating a buy trade. Liquidity appears in various forms within the market, but we primarily focus on equal highs and equal lows. As the term implies, equal lows occur when multiple low points align at roughly the same level, and likewise, equal highs form when price peaks are positioned at similar levels. What does this indicate in the context of price action? The double or triple bottoms created on the chart are great places to look for trading opportunities. For many retail traders, they expect action to the upside once the price taps into this area again, so they enter long positions at these levels and place their stop losses somewhere below this area. A similar pattern unfolds in bearish markets. When price touches a resistance zone, retail traders often enter short positions, anticipating a downward rejection. Their stop losses are typically placed just above this level, leading to a build-up of liquidity in that area. If smart money intends to sell this pair, the setup is ideal to drive the price above the resistance, capture the liquidity, and then shift it back in the original bearish direction. The third concept is the market maker model. What exactly is the market maker model within institutional price movements? There are two main types of liquidity in the market: buy side and sell side. Buy side liquidity exists above a high or a cluster of highs. As price nears this level, bearish traders often enter short positions or safeguard existing ones, while breakout traders may go long if price breaches this zone. The aggressive price movement designed to capture this liquidity is known as buy-side delivery. It pushes price higher to tap into the liquidity above those relative equal highs. This algorithmic move traps traders on both ends, setting the stage for smart money to enter short positions. Now, let's apply the same principle to a bearish context. Liquidity located beneath a low or a cluster of lows is referred to as sell-side liquidity. Similar to the bullish case, as price nears this zone, bullish traders may enter long trades or defend their existing long positions, while breakout traders will short if price breaks below the level. The sharp price movement designed to capture this liquidity is known as sell-side delivery. It targets the liquidity below those lows. This algorithmic move traps traders on both sides, allowing smart money to enter long positions and pursue buy-side liquidity. When price forms support levels and internal structures ahead of reaching a demand zone, the probability of a bounce from that zone increases. This happens because such supports attract buyers, whose stop losses act as sell orders. For smart money to accumulate long positions, selling pressure is required. This setup provides exactly that. The price often reacts at the demand level as buyers capitalize on the perceived value and sellers' orders are absorbed by the buying momentum. With that in mind, spotting liquidity grab patterns within supply or demand zones offers strong confirmation of potential short-term market structure reversals. After these patterns form, the market typically moves in the direction of the nearest liquidity zones. On the other side, market direction: who is in control? Determining the overall market direction is typically the initial step when analyzing a price chart. The goal is to identify the prevailing trend and assess whether buyers or sellers are currently in control. Our strategy always focuses on trading in alignment with the dominant force in the market. How does this system function? It's based on mitigations. When price revisits and mitigates a demand zone, buying pressure tends to outweigh supply, allowing demand to take control. On the flip side, when price revisits and mitigates a supply zone, selling pressure takes over, allowing supply to dominate demand. Picture the market in an uptrend, consistently forming higher highs and higher lows. Every time the structure breaks to the upside accompanied by inefficiency, a new demand zone is established. These zones stay unmitigated until price returns to them, presenting ideal setups to align with the prevailing bullish trend. These demand zones remain untouched until price revisits them, presenting an ideal chance to trade with the prevailing trend. However, if price drops below a confirmed demand zone, it signals a change of character, meaning two things. First, supply has overtaken demand, and second, a legitimate supply zone has been created. Price then begins to decline, forming new supply zones, until it encounters the next unmitigated demand area. At this stage, a tug-of-war emerges between supply and demand, often resulting in consolidation and a ranging market between the two levels. A breakout from either zone reveals which side gains control. In this scenario, we observe 1, 2, and 3 successive moves breaking above previous market structure highs, confirming that demand is currently in control. A previously unmitigated demand zone forms, which is expected to act as support when the price retraces to it. Following a brief correction, the price once again pushes higher with noticeable imbalance, creating another strong demand zone. As long as the price remains above this extreme demand level, the market sentiment remains bullish. However, when the price tests the demand area and fails to generate a new higher high, it signals a potential weakening of buyer momentum. Once the market breaks below the previous low, it confirms that demand is no longer in control. This shift suggests a possible trend reversal. If we mark this point as the origin of the impulsive move that disrupted the bullish market structure, it becomes a valid supply zone and the beginning of a new bearish leg. This marks the origin of our newly established supply zone. As the market continues to break structure to the downside, it confirms that supply is currently in control. During this phase, the price forms multiple supply zones, each presenting potential selling opportunities in alignment with the bearish sentiment. The downtrend persists until price reaches an unmitigated demand zone positioned below. This zone represents a potential area of interest where buyers may attempt to re-enter the market. At this point, a tug-of-war between supply and demand begins, creating a critical juncture. We must closely monitor price action around this level, as it could act as a significant turning point, either leading to a market reversal or a temporary corrective move before continuation of the existing trend. While we cannot control the market, we can control how we prepare for it. By anticipating multiple scenarios and aligning our strategy with the dominant structure, we maintain an edge and respond with confidence, not emotion. Now let's continue with the next topic: order blocks. Order blocks are essentially refined zones of supply and demand, where clusters of buy or sell orders are typically positioned. These price levels have been denied by the market. Once price returns to these levels, it may respond to them again. All order blocks are supply or demand zones, but not all supply and demand areas meet the criteria to be considered order blocks. Let me demonstrate how each reaction to a price level forms a supply or demand zone. It indicates that, for some reason, traders have executed large-scale buy or sell orders, leading to strong price shifts. Therefore, when price returns to these zones, we carefully observe the price action to identify potential trade setups. Still, trading every supply and demand zone isn't practical in the long run. Through analyzing recurring chart behavior, we've found that when supply and demand zones meet specific criteria, the likelihood of a successful trade improves significantly. One of the most reliable supply and demand structures is the order block. So first, let's explore what factors make a zone a valid order block for trading, and then I'll walk you through how to accurately identify them on the chart. Criteria for a valid order block. The first and second requirements are the presence of inefficiency and liquidity grab, which we covered earlier in the video. The third requirement for confirming a valid order block is a break in market structure. In a bullish setup, when a price swing breaks the most recent market structure and closes above the previous high, the starting point of that move gains major significance. It indicates that the demand zone driving this move is not just any level, but a key area within the market structure. With that in mind, a supply or demand zone qualifies as a valid order block if it results in a structural break. The same concept applies to the bearish scenario. When a price movement breaks the latest market structure to the downside, the origin of the price movement becomes highly important. It shows that the supply area that created this movement is not an ordinary level but an influential zone in the market structure, so these supply areas are considered valid order blocks. Here we see an upward trend in motion. This marks the most recent structural break, confirming that demand remains dominant. Each of these demand zones presents a potential long opportunity. However, it's crucial to note that the starting point of this bullish move holds the most value and offers the strongest trade setups. There's a strong possibility that the remaining zones fall prey to a liquidity sweep. That's why it's essential to apply reduced risk when executing trades in such areas. Always keep in mind, while a solid trading strategy can grow your account, a proper risk management plan is what keeps you in the game. You can risk around 2 to 3% of your capital per trade and limit yourself to a maximum of 3 open positions at once. Let's move forward now and dive into the next concept: breaker blocks. A breaker block is an invalidated order block that transforms into a new supply or demand zone on the chart. According to basic price action principles, when price breaks above a resistance level, it often flips into support due to trader behavior. Similarly, when price breaks below a support level, it typically acts as resistance once revisited. This exact concept also applies to order blocks. The market may overlook a supply or demand order block for several reasons, such as a shift in market structure, being overvalued or undervalued, hitting a major level on a higher time frame, and more. When a valid demand order block doesn't hold and price breaks below it, it shifts into a supply zone. This is referred to as a breaker block, where we expect potential rejection from the market. Now, in this example, here's how a bearish setup might appear. We get a structure break above this recent high, along with inefficiency. That movement forms a valid order block zone, presenting us with a possible long entry. But then the market shows a shift in character due to a strong bearish move breaking below the prior low. This signals a change in directional bias to bearish. turning our former demand zone into a supply level. The psychology behind breaker blocks is that traders who went long from the order block are now trapped after the bearish structure shift, and they'll likely wait for price to return to their break-even point to exit without loss. At the same time, new sellers will enter short positions at this level, viewing it as a major supply zone. This combination of actions is what causes price to reverse from this area. The final concept we'll cover is market structure. Market structure involves swing highs and lows, supply and demand zones, order flow, and the general state of the market. There are two types of market behavior: trending markets and ranging markets. In an uptrend, as the name suggests, the market moves towards the upside, creating new higher highs and higher lows. Here you see an ideal ascending structure. The ideal means that the market respects the lows and continues pushing upwards. The important point is that in the uptrend, the market has a greater tendency to break the highs to the upside, although the market might not always move this clearly. This is the general definition that is commonly seen in the market. Even if you look at the 1-minute chart, you can see that the upward movement is created by making higher highs and lows, so as long as the price continues to break the structure levels to the upside, we are still in an uptrend. Now that we've discussed breaks, let's explore what a break truly signifies and the criteria we look for in a structure break. But before anything else, this is the basic anatomy of a candlestick on the chart. They may vary in shape and size, but they become crucial when discussing breaks and liquidity concepts. Structure and liquidity are two elements of the market that cannot be separated. Many liquidity zones gain relevance through structure, and numerous structure levels lose validity without liquidity concepts. It's something that can be challenging to grasp. But we'll break it all down today. So, how does a breakout actually happen? A breakout takes place when a candlestick's body decisively moves beyond the previous market structure. This means if the price closes noticeably, by a few pips, above the prior level, it qualifies as what we refer to as a break of structure. But here's a key point: how do we confirm that this break is genuine and not simply a liquidity sweep? In the event of a fake out or liquidity sweep, the price quickly returns back within the previous range. So, let's elevate our concept. If the price wicks above the prior market structure but ends up closing back within the range, we don't have a valid breakout, as explained earlier. To confirm a legitimate break, the next candle must close higher than the previous one. This clearly signals that sellers failed to drag the price back into the range and buyers have taken control. Likewise, a second confirmation of a break of structure with a closed body is to wait for the next candle to break above the previous candle's highest point. This suggests strong upward momentum, not just a liquidity sweep. Keep in mind, everything we've covered here also applies in reverse for a bearish scenario. Now, let's move forward to the next concept: reversals. As we touched on earlier, the market typically exhibits two types of behavior: trending and ranging. At times, it can be challenging to determine the market's direction, or it might seem like price is just moving within a confined zone. Since ranging markets are beyond the scope of this video, let's zero in on how an uptrend transitions into a downtrend and the reverse, in other words, a market reversal. When should we lean toward a bullish or bearish outlook? As discussed earlier, a shift in market character happens when the origin point is broken. A breakout takes place when a candlestick clearly closes beyond a key level in the market structure. Therefore, our first step is to pinpoint these origin areas to accurately identify potential reversal zones. But here's a key point: time frames play a significant role in recognizing a change in market character. For example, both of these zones qualify as sources since they've broken past prior market structure. However, we wouldn't treat this as a valid character shift. That's because the breakdown of such a minor move shouldn't be interpreted as a full trend reversal. So, here's another guideline for confirming a change in character. A valid change of character happens when the price drops below the lowest point of the latest impulsive move, which must be at least half the size of the previous one. For instance, take a look at this chart. Using market structure concepts, we can identify 3 impulsive moves like this. Each created a new high, so a break below the source of any is seen as a change of character, but notice the third impulse: it's barely half the size of the one before it. So in this case, if the price breaks below the swing low, we won't treat it as a valid change of character. Essentially, we compare the scale of the most recent impulsive move with the previous one, and it must be at least 50% of the prior move to count as a legit reversal. For example, if the last impulse was 40 pips, the current one needs to be at least 20 pips. Anything less, and we can't confirm a valid shift in market direction. Here in the bearish scenario, these are our impulsive bearish movements. Breaking above this level is considered a valid change of character because the impulsive move is clearly larger than half of the previous one. Always remember, we compare the most recent impulse with the one that came right before it. Regardless of your entry strategy, aligning your trades with the dominant market direction significantly boosts your win rate and improves your risk-to-reward ratio. Always remember, before running any setup on a real account, make sure to backtest it across multiple pairs using historical data. This helps you evaluate the true performance and reliability of your strategy. We do a lot of backtesting too, but let's be real, it's time-consuming. Still, it's the key to building solid confidence and consistency in your trading game. One of the most crucial concepts for identifying trends and potential reversal points on the chart is liquidity. Understanding where liquidity is resting helps us anticipate market moves, trap zones, and smart entry points with higher accuracy. When discussing liquidity, it's important to note that it generally pulls above recent highs and below recent lows. If we consider these zones in relation to market structure, price often dips below a recent low to grab liquidity before continuing higher to sweep liquidity above the recent high. In most cases, this liquidity sweep serves as a fuel source for trend continuation. For instance, in a bullish market, price typically sweeps liquidity below swing lows to accumulate orders, then drives upward with renewed momentum. Candlestick formations play a crucial role in identifying liquidity sweep movements. A long wick at the bottom of a candlestick typically signals a liquidity grab, especially when it breaks below a well-established support level. This area often holds clustered buy orders and stop losses. When price pierces this zone with a sharp wick and quickly rejects it without forming a significant upper wick, it indicates a strong buy-side reaction. This behavior suggests that institutional players may be absorbing liquidity before initiating a bullish move. However, it's important to note that price action isn't always mechanical. Each scenario should be evaluated within its broader market context. What we ideally want to observe during a liquidity grab is a wick that penetrates decisively through a key level, such as a previous support or resistance, and then quickly rejects back. For the move to be considered valid and meaningful, the wick should be at least half the size of the candlestick body. This demonstrates that the market aggressively pushed beyond the level to trigger stop losses or collect liquidity, but buying pressure, or selling pressure in a bearish case, stepped in with force, causing a sharp rejection. This type of price behavior often precedes strong reversals or continuations. Previously, we highlighted that a valid trend reversal typically requires the break of a source level. However, when liquidity concepts are combined with market structure, a liquidity sweep above a recent higher high can also serve as an early sign of potential reversal. For instance, if price sweeps the liquidity above a recent high, especially the one responsible for breaking structure to the upside, but fails to continue higher or form a new high, this signals possible exhaustion of bullish momentum. It's crucial to distinguish this from a liquidity sweep that aligns with the dominant trend, which often leads to continuation. A sweep against the prevailing trend indicates a shift in market sentiment and can act as an early warning for trend reversal. This nuanced difference is essential for refining entries and managing risk. Grabbing liquidity above a recent high typically signals a temporary reversal. It shows that the market has targeted stop losses or pending orders clustered above that high. However, we don't assume a full trend reversal based solely on this liquidity sweep. A true, confirmed reversal occurs only when the price breaks and closes below the most recent origin point, the structural low that initiated the previous impulse move. Once this origin is broken, it indicates that the bullish structure has failed, confirming that the uptrend is over and the market may now continue in a bearish direction. The same concept applies in a bearish scenario. A liquidity sweep below the most recent low often signals a potential short-term reversal within the dominant downtrend. From a price action perspective, this suggests that sellers have failed to establish a new low, indicating a loss of momentum. If the price quickly re-enters the previous range after the sweep, it shows early signs of bullish pressure. This upward momentum can drive the price toward the next visible supply level. However, a true trend reversal is only confirmed when the price breaks and closes above the origin point, the structural high that led to the last bearish impulse. This marks a valid change of character and shifts the bias to bullish. On the 5-minute chart of gold, the market sentiment is strongly bullish, consistently forming higher highs and higher lows. Notably, the presence of equal lows indicates a significant liquidity pool. These equal lows act as the source for the most recent break of structure, suggesting that a liquidity sweep at this level could serve as a potential signal for continued upward momentum. Therefore, a liquidity sweep pattern forming at these equal lows serves as a strong signal for bullish continuation. Conversely, if a liquidity sweep occurs above a recent high, it often indicates a potential short-term reversal, suggesting the current bullish momentum may be weakening. This reversal is confirmed when the price breaks below the most recent source point that initiated the break of structure. At that point, a directional shift becomes likely, and the market may continue pushing downward. Practicing these concepts directly on your charts will significantly enhance your technical analysis skills, deepen your understanding of price action, and help optimize your trade entries. If you found value in this video, be sure to like and share your support. And if you're new to the channel, consider subscribing for more insightful trading content. See you in the next episode.